Coming at you live from the beautiful heartland of these good old United States of America, right at the confluence of the mighty Mississippi and the majestic Missouri rivers, St. Charles, Missouri. This is the Rant. I am your host, Charles Lamson. I'll be with you for the next 2 hours. YouTube gods be willing. Blog Talk Radio, I should be, regardless, but the YouTube gods can be fickle and capricious. Okay, but anyway, ladies and gentlemen, so today is it's Wednesday, the 23rd day of October, year of our Lord, 2019. And today's topic, this is going to be the conclusion of public relations and economic perspective. First half of the big show, going to be doing something a little bit different. I started it 2 days ago, I guess, but I usually like to do seances in the first half of the show, using the creepy Tibetan bowl music and my awesome powers as a practitioner of the black arts. And so I was going to, we usually summon the spirits of really, brilliant dead guys for asking for advice. And in these times of great political and economic uncertainty and turmoil. And, so I'm doing something a little bit different. This is more of a summoning type ritual, a summoning type seance ritual. I'm going to channel the spirit of George Soros. I'm going to call for the spirit of George Soros to come here and kind of share with us a little bit about his alchemy of finance. And so that should be great. And, I know you're probably saying, well, he's not dead yet, so you can't really, how are you? Well, see, I know, ladies and gentlemen, it's all part of my plan. He's really old. He can't live forever. So I'm just trying to, as a practitioner of the black arts, I'm just trying to sort of get his spirit over here. As if my goal is to, if he can pass away, before I finish this series of shows summoning the spirit of George Soros, maybe I can trap his spirit over here. And then he can give me all kinds of wicked financial advice and advice on how to expand my huge global communications empire. So I'm just saying, just think about it, George. I know it might be a little premature, me jumping the gun like this, but I just wanted to get first dibs. I think you're a man who can appreciate that. So, being a little bit Machiavellian here so I can survive. You're all about survival, right, George? Well, me too. It's not easy being a gimp in America. Much like I imagine it was pretty damn hard being a Jew during World War II as well. So it's all about survival, George. You can appreciate that. We're kindred spirits. So just think about it. All right, so that'll be the first half of the show. Yeah, and then while we're doing that, I guess my great sacrifice to the universe to make all this happen will be I'm going to be doing an inspirational, motivational, fitness instructional video for 50-year-old crippled people or older. So, yeah, you guys will definitely want to watch that on YouTube. By the way, I guess on Blog Talk Radio, you won't be able to hear, you'll just be able to hear me huffing and puffing in the background. I swear to God, I'm not doing anything bad. I'm just being proactive and getting my workout in while I'll be listening to the spirit of George Soros. He's we got another medium who's going to be channeling his spirit. It's not going to be me, but so this guy has an American accent. So then the second half, I'm going to come back and we're going to wrap up our discussion on public relations for now. I focus on pretty heavily on that on the blog, which is charleslamson.blogspot.com. And the podcast is blogtalkradio.com/Charles Lamson. And anyway, I'm going to come back. I'm going to wrap up the discussion on public relations. If we take some phone calls as well in the second half. And with what time there is left, I plan on going over some financial news, some timely financial top stories, as it were. Top stories I know, but they're at it's a teaser, ladies and gentlemen. You'll have to stay tuned for the whole episode. Okay, so, ladies and gents, let's get this shindig started, shall we? George, come to us. I call upon the spirit of George Soros. Come, give us your advice. We need it.
Investment trusts. REITs, as they are called, are a special corporate form brought into existence by legislation. Their key feature is that they can distribute their income free of corporate taxation, provided they distribute all the income they receive. The opportunity created by this legislation remained largely unexploited until 1969, when a large number of REITs were founded. I was present at the creation and, fresh from my experience with conglomerates, recognized their boom-bust potential. I published a research report, The Case for Mortgage Trusts. My report had an interesting history. It came at a time when go-go fund managers had suffered severe losses in the collapse of the conglomerates. Since they were entitled to share in the profits but did not have to share in the losses of the funds they managed, they were inclined to grasp at anything that held out the prospect of a quick profit. They instinctively understood how a self-reinforcing process works, since they had just participated in one and they were anxious to play. The report found a tremendous response, whose extent I realized only when I received a telephone call from a bank in Cleveland asking for a new copy because theirs had gone through so many Xerox incarnations that it was no longer legible. There were only a few mortgage trusts in existence at the time, but the shares were so eagerly sought after that they nearly doubled in price in the space of a month or so. Demand generated supply, and there was a flood of new issues coming to market. When it became clear that the stream of new mortgage trusts was inexhaustible, prices fell almost as rapidly as they had gone up. Obviously, the readers of the report failed to take into account the ease of entry. Their mistake was corrected in short order. Nevertheless, their enthusiastic reception helped to get the self-reinforcing process described in the report underway. Subsequent events took the course outlined in the report. Mortgage trust shares enjoyed a boom that was not as violent as the one that followed the publication of the report, but turned out to be more enduring. I had invested heavily in mortgage trusts and took some profits when the reception of my study exceeded my expectations. But I was sufficiently carried away by my own success to be caught in the downdraft with a significant inventory. I hung on and even increased my positions. I followed the industry closely for a year or so and sold my holdings with good profits. Then I lost touch with the group until a few years later when problems began to surface. I was tempted to establish a short position, but was handicapped in that I was no longer familiar with the terrain. Nevertheless, when I reread the report I had written several years earlier, I was persuaded by my own prediction. I decided to sell the group short, more or less indiscriminately. Moreover, as the shares fell, I maintained the same level of exposure by selling additional shares short. My original prediction was fulfilled, and most REITs went broke. The result was that I reaped more than 100% profit on my short positions. A seeming impossibility, since the maximum profit on a short position is 100%. The explanation is that I kept on selling additional shares. Self-reinforcing, self-defeating cycles like the conglomerate boom and the REITs do not occur every day. There are long fallow periods when the specialist in such cycles remains unemployed. He need not starve, however. The divergence between underlying trends and investor recognition persists at all times, and the astute investor can take advantage of it. New industries arise or old ones come back into favor. Typically, they are inadequately followed at first. For instance, when defense spending started to rise in the early 1970s after a long decline, there were only 2 or 3 analysts left who followed the industry, although it still represented a substantial portion of the economy. Those who were left were too demoralized to recognize the beginning of a major new trend. That was a wonderful time to invest in defense stocks. There were high-tech defense stocks that had never been visited by an analyst, like E-Systems, Inc., and well-established companies that had fallen on evil days trying to diversify out of defense, like Sanders Associates, or getting caught up in scandals trying to sell airplanes through bribery, like Northrop and Lockheed. In the case of defense stocks, there was no self-reinforcing process involved, but investor recognition certainly helped the price of the stocks. Actually, it is a rare case where the investor's bias leaves the fundamentals totally unaffected. Even with defense stocks, the prevailing bias played a role, but it was a negative one. Lockheed had to be bailed out by the government, and companies like Sanders Associates had to restructure their debt by offering convertible bonds at prices that turned out to be very low in retrospect. Only when the negative bias was corrected was there very little further feedback. Companies had little need for additional capital, and managements, having been burned once before, were leery of diversifying out of defense. There were exceptions, like United Aircraft, but investors' bias never turned positive enough to allow a self-reinforcing process to get underway. Many of you for cash, and those that involved stock did not enhance earnings significantly. The result was a larger, diversified company, but no boom and bust in the stock. Perhaps the most interesting case of negative bias occurred in technology stocks. After the stock market debacle of 1974, investors were leery of any company that needed to raise equity capital from outside sources. Distributed data processing was in the early stages of its development. Companies like DataPoint and 4-Phase were in the vanguard, with IBM lagging badly. The market was practically exploding, but these little companies were hamstrung by their inability to raise capital. The stocks were selling at very low multiples of anticipated earnings, and the main argument against them was that they would not be able to grow fast enough to meet the demand, and eventually IBM would move into the market. The argument turned out to be valid, but not before these companies became large and prosperous and investors became eager to throw money at them at high multiples. Those who had been willing to fight the negative bias were amply rewarded. As the various niches occupied by these small companies converged to form a large market, most of them were absorbed by larger companies, and those that stayed independent fell on evil days. DataPoint is currently looking for a home at a much reduced multiple. 4-Phase was recently acquired by Motorola, which proceeded to lose its shirt on it. If the initial market reaction to distributed data processing companies had been more positive, it is possible that some of the early starters, just a wave of microcomputer manufacturers, did spawn a few enduring companies like Digital Equipment and Data General. The negative bias of the 1975 to 1976 period gave way to the opposite extreme. It found expression in a venture capital boom that culminated in the second quarter of 1983. The sequence of events is not as clear-cut as in the case of REITs, but that is only because high technology is not as homogeneous an industry. The same reflexive interaction between stock prices, prevailing bias, and fundamentals can be observed, but much more specific knowledge is required to trace the course of events. The availability of venture capital on attractive terms led to a proliferation of new ventures. Every new company needed equipment as well as inventory, so that electronic equipment manufacturers enjoyed a boom, and so did the manufacturers of products and components. The electronics industry is a large customer of its own products, so that the boom was self-reinforcing. But the proliferation of companies intensified competition. Industry leaders lost their market position as a new generation of products was introduced because the individuals who were responsible for developing them left their companies and set up new ones. Instead of companies growing in step with their industry, the industry grew by the multiplication of companies. Investors failed to recognize this trend. As a result, technology stocks in general and new issues in particular became substantially overvalued. The new issue boom culminated in the second quarter of 1983. When prices started to decline, fewer issues could be sold, and eventually venture capitalists became less venturesome. As fewer companies were formed and the existing ones depleted their cash, the market for technology products softened. Competition intensified and profit margins deteriorated. The process started to feed on itself, and the low point has probably still not been reached. The venture capital boom was not the only cause of the subsequent shakeout. The strong dollar and the rise of Japanese competition were at least as important. But it is clear that stock prices had an impact on the fundamentals in both directions. What distinguishes the conglomerate and REIT sequences from the venture capital boom is that in the first two cases, the underlying trend itself was based on the exploitation of the investor's bias, while in the third, it was not. In the case of conglomerates, the idea was to acquire other companies with inflated paper. In the case of REITs, the idea was equity leveraging. The idea behind the latest generation of technology products had nothing to do with the stock market. To understand the ups and downs of technology stocks, we must know something about the underlying trends in technology. In the case of conglomerates and REITs, we need to know little else than the theory of reflexivity. It is important to realize, however, that knowing everything about underlying trends in technology is not sufficient to explain the ups and downs of technology stocks. The reflexive interaction between underlying trends, prevailing biases, and stock prices also needs to be understood. Combining the two kinds of understanding is extremely difficult. Those who want to be familiar with technology must follow the industry closely and continuously. Those who want to exploit the divergence between perception and reality must move from group to group. Most technology experts are ignorant of reflexivity and tend to remain fully invested at all times. Their popularity and influence wax and wane in a reflexive fashion. After the recent decline in technology stocks, a new breed of analysts seems to be emerging who are overly sensitive to the importance of investors' perceptions. After a decent interval, it may be once again profitable to go against the prevailing bias and invest in technology stocks on the basis of fundamental trends. I have always had a lot of difficulty investing in technology stocks because of the specialized knowledge required. Finally, I managed to gain a good insight into the computer industry during the 1975 to 1976 period and profited from the prevailing negative bias. I held on to my positions for a few years, but then I sold them and lost my grip on the industry. In 1981, I made the mistake of not participating in a venture capital fund operated by one of the most successful venture capitalists of the period, in the belief that the boom could not last long enough to allow investors to exit in time. In this, I was undoubtedly influenced by misgivings about the larger picture. In any event, his investors realized a good profit in 1983. By that time, I was totally out of touch with technology stocks, and the boom passed me by. Even the conglomerate and REIT sequences were not totally self-contained. Extraneous developments, such as the level of economic activity, regulation, or specific events, e.g. the attempted takeover of Chemical Bank, played a crucial role in the conglomerate boom. In less pure sequences, the importance of outside influences is even greater. We are currently in the midst of another self-reinforcing, self-defeating cycle that will go down in history as the merger mania of the 1980s. Instead of inflated paper, it is cash that serves as the currency. The scale of transactions already dwarfs the conglomerate boom. Merger mania is but an element of a much larger ongoing historical drama whose ramifications reach far beyond the stock market and involve politics, exchange rates, monetary and fiscal policies, quirks of taxation, international capital movements, and many other developments. I shall make an attempt at unraveling the ongoing historical drama, but that is not as simple as analyzing a more or less self-contained boom-bust sequence. The larger picture is full of reflexive interactions as well as non-reflexive fundamental trends. We need a more complex model that allows for the transition from one boom-bust sequence to another and for the coexistence of several reflexive processes at the same time. Before I embark on such an ambitious project, I want to examine that is characterized by vicious and benign circles, the currency market. Reflexivity in the currency market. While reflexive interactions are intermittent in the stock market, they are continuous in the market for currencies. I shall try to show that freely floating exchange rates are inherently unstable. Moreover, the instability is cumulative, so that the eventual breakdown of a freely floating exchange rate system is virtually assured. The traditional view of the currency market is that it tends toward equilibrium. An overvalued exchange rate encourages imports and discourages exports until equilibrium is reestablished. Similarly, an improvement in competitive position is reflected in an appreciating exchange rate that reduces the trade surplus so that equilibrium is again reestablished. Speculation cannot disrupt the trend toward equilibrium. If speculators anticipate the future correctly, they accelerate trend. If they misjudge it, they will be penalized by the underlying trend that may be delayed but will inexorably assert itself. Experience since floating exchange rates were introduced in 1973 has disproved this view. Instead of fundamentals determining exchange rates have found a way of influencing the fundamentals. For instance, a strong exchange rate discourages inflation. Wages remain stable and the price of imports falls. When exports have a large import component, a country can remain competitive almost indefinitely in spite of a steady appreciation of its currency, as Germany demonstrated in the 1970s. The fact is that the relationship between the domestic inflation rate and the international exchange rate is not unidirectional, but circular. Changes in one may precede changes in the other, but it does not make sense to describe one as the cause and the other as the effect, because they mutually reinforce each other. It is more appropriate to speak of a vicious circle in which the currency depreciates and inflation accelerates, or of a benign circle where the opposite happens. Vicious and benign circles are a far cry from equilibrium. Nevertheless, they could produce a state of affairs akin to equilibrium if the reflexive, mutually self-reinforcing relationship could be sustained indefinitely. But that is not the case. The self-reinforcing process tends to become more vulnerable the longer it lasts, and eventually it is bound to reverse itself, setting in motion a self-reinforcing direction. A complete cycle is characterized by wide fluctuations, not only in the exchange rate, but also in interest rates, inflation, and/or the level of economic activity. The participant's bias introduces an element of instability into the system. If the system had an innate tendency toward equilibrium, the participant's bias could not disrupt it. At worst, it could introduce some random short-term fluctuation. Causal connections are reflexive. The participant's bias may engender, sustain, or destroy a vicious or benign circle. Moreover, the prevailing bias takes on a life of its own as one of the constituent parts in a circular relationship. It finds expression in allowing a trade surplus or deficit to exceed, both in size and in duration, the level that could have been sustained in its absence. When that happens, speculation becomes a destabilizing influence. International capital movements tend to follow a self-reinforcing, self-defeating pattern similar to the one we identified in the stock market. But the model we used for stock price movements cannot be applied to currency markets without substantial modifications. In the stock market, we focused on the reflexive relationship between two variables, stock prices and possible model, and we were willing to simplify a much more complex reality to serve our purpose. In the current market, we cannot get by with two variables. Even the simplest model will need 7 or 8. Expectations about exchange rates play the same role in currency markets as expectations about stock prices do in the stock market. They constitute the paramount consideration for those who are motivated by the total rate of return. In the stock market, that covers practically all investors. In currency markets, all speculative transactions. In the stock market, we used a model that focused on stock prices and disregarded dividend income. No great distortion was involved because in the kind of boom-bust sequences we were considering, stock price movements far outweigh dividend income. Similar conditions prevail in currency markets. Expectations about future exchange rates constitute the main motivation in speculative capital transactions. The major difference between the stock market and the currency market seems to be the role played by the fundamentals. We have seen that the fundamentals were rather nebulous even in the case of stocks, but at least we had no reason to doubt that stock prices were somehow connected to the fundamentals. In the case of currencies, the trade balance is clearly the most important fundamental factor. Yet the dollar strengthened between 1982 and 1985, while the trade balance of the United States was deteriorating. It would seem that the fundamentals are even less relevant in determining price trends than in the stock market. We do not need to look far afield for an explanation. It is to be found in the relative importance of speculative capital movements. As we have seen, speculative capital is motivated primarily by expectations about future exchange rates. To the extent that exchange rates are dominated by speculative capital transfers, they are purely reflexive. Expectations relate to expectations, and the prevailing bias can validate itself almost indefinitely. The situation is highly unstable. If the opposite bias prevailed, it could also validate itself. The greater the relative importance of speculation, the more unstable the system becomes. The total rate of return can flip-flop with every change in the prevailing bias. In our discussion of the stock market, we identified certain sequences, such as the conglomerate boom, where the prevailing bias formed an important part of the underlying trend. But we concluded that such pure examples of reflexivity are exceptional. By contrast, in a system of freely fluctuating exchange rates, reflexivity constitutes the rule. Of course, there is no such thing as a purely reflexive situation. Speculation is only one of the factors that determine exchange rates, and the other factors must also be taken into account in formulating one's expectations. Thus, expectations cannot be totally capricious. They must be rooted in something other than themselves. How a prevailing bias becomes established, and, even more important, how it is reversed, are the most important questions confronting us. There are no universally valid answers. Reflexive processes tend to follow a certain pattern. In the early stages, the trend has to be self-reinforcing, otherwise the process aborts. As the trend extends, it becomes increasingly vulnerable because the fundamentals, such as trade and interest payments, move against the trend in accordance with the precepts of classical analysis, and the trend becomes increasingly dependent on the prevailing bias. Eventually, a turning point is reached, and, in a full-fledged sequence, a self-reinforcing process starts operating in the opposite direction. Within this general pattern, each sequence is unique. It is the characteristic feature of a reflexive process that neither the participants' perceptions nor the situation to which they relate remain unaffected by it. It follows that no sequence can repeat itself. Not even the variables that interact in a circular fashion need be the same. Certainly, they will not carry the same weight on different occasions. Although each self-reinforcing circle is unique, we can make some universally valid generalizations about freely fluctuating exchange rates. First, the relative importance of speculative transactions tends to increase during the lifetime of a self-reinforcing trend. Second, the prevailing bias is a trend-following one, and the longer the trend persists, the stronger the bias becomes. The third is simply that once a trend is established, it tends to persist and to run its full course. When the turn finally comes, it tends to set into motion a self-reinforcing process in the opposite direction. In other words, currencies tend to move in large waves, with each move lasting several years. These three tendencies are mutually self-validating. It is the growth in speculative capital flows moving in a trend-following fashion that makes the trend so persistent. It is the persistence of the trend that makes a trend-following bias so rewarding, and it is the rewards reaped by speculation that attract increasing amounts of capital. The longer a benign circle lasts, the more attractive it is to hold financial assets in the appreciating currency, and the more important the exchange rate becomes in calculating total return. Those who are inclined to fight the trend are progressively eliminated, and in the end, only trend followers survive as active participants. As speculation gains in importance, other factors lose their influence. There is nothing to guide speculators but the market itself, and the market is dominated by trend followers. These considerations explain how the dollar could continue to appreciate in the face of an ever-rising trade deficit. Eventually, a crossover point would have been reached, even without the intervention of the authorities, when the inflow of speculative funds could not keep pace with the trade deficit and with rising interest obligations, and the trend would have been reversed. Since the predominating bias is trend following, speculative capital would then have started moving in the opposite direction. If and when that happened, the reversal could easily have accelerated into a free fall. For one thing, speculation and fundamental flows would then have worked in the same direction. Even more important, when a change in trend is recognized, the volume of speculative transactions is likely to undergo a dramatic, not to say catastrophic, increase. While a trend persists, speculative flows are incremental, but a reversal involves not only the current flow, but also the accumulated stock of speculative capital. The longer the trend has persisted, the larger the accumulation. There are, of course, mitigating circumstances. One is that market participants are likely to recognize a change in trend only gradually. The other is that the authorities are bound to be aware of the danger and do something to prevent a crash. How the drama actually unfolded will be the subject of a later chapter. Here we are trying to establish a general proposition. Taking the three generalizations together, it can be asserted that speculation is progressively destabilizing. The destabilizing effect arises not because the speculative capital flows must be eventually reversed, but exactly because they need not be reversed until much later. If they had to be reversed in short order, capital transactions would provide a welcome cushion for making the adjustment process less painful. If they need not be reversed, the participants get to depend on them, so that eventually, when the turn comes, the adjustment becomes that much more painful. It is quite likely that the generalization about the progressive accumulation of hot money holds true not only within a cycle, but also from one cycle to another. Although the history of fluctuating exchange rates is too short to provide reliable evidence. It has certainly been true so far. The size of speculative capital movements was far greater in Reagan's benign circle than it was during Carter's vicious circle. Empirical studies of the 1930s also showed a cumulative growth in hot money movements, although circumstances were somewhat different because currencies were not freely floating. We can see why hot money should continue to accumulate as long as real interest rates are high and the return on physical investments low. Keeping capital in liquid form in an appreciating currency is more rewarding than investing it in physical assets. What is needed to give the generalization universal validity is an argument that would show that fluctuating exchange rates are associated with high returns on financial assets and low returns on physical investments. Let me try. We have seen that hot money can earn exceptional returns if it gets the trend right. Since it sets the trend, that is likely to be the case. Physical assets represent the opposite side of the coin. They cannot move to take advantage of the trend. The tradable goods sector is bound to suffer when a currency appreciates. Of course, a depreciating currency brings windfall profits to exporters, but having been hurt before, exporters are loath to invest in the basis of a temporary advantage. They prefer to hold their profits in financial assets, contributing to the growth of hot money. The process can be most clearly observed in the United Kingdom, where exporters refused to expand when sterling fell below $1.10 in 1985, despite record profits. How right they were! Sterling rose above $1.50 by April 1986. Thus, both an appreciating currency and a depreciating currency discourage physical investment and foster the accumulation of hot money. We can attempt yet another tentative generalization. When a long-term trend loses its momentum, short-term volatility tends to rise. It is easy to see why that should be so. The trend-following crowd is disoriented. The generalization is tentative because it is based on inadequate evidence. It certainly was true when the dollar reversed its trend in 1985. If these generalizations are indeed valid, the eventual demise of a system of freely fluctuating exchange rates is inevitable. Fluctuations become so wild that either the system has to be modified by some kind of government intervention, or it is bound to break down. Currency markets thus provide the best support for my contention that financial markets are inherently unstable. There is no built-in tendency toward equilibrium. To the extent that we need stability, we must introduce it by deliberate policy measures. These conclusions may not strike the reader as particularly revolutionary at the present time, but they certainly contradicted the prevailing wisdom at the time they were written in April to May 1985. There was widespread malaise about the instability of exchange rates, but belief in the magic of the market was still running strong. And the famous Plaza Agreement in September 1985 came as something of a shock to market participants. Even today, there is no theoretical underpinning for the contention that a freely floating exchange rate system is cumulatively destabilizing. That is what I hope to have provided here. I have been speculating in currencies ever since they started floating, but I have failed to make money on a consistent basis. On balance, I traded profitably through 1980, then chalked up losses between 1981 and 1985. My approach has been tentative, based more on intuition than on conviction. By temperament, I have always been more interested in picking the turning point than in following a trend. I managed to catch both the rise and fall of European currencies against the dollar in 1981, but I traded myself out of my positions too soon. Having lost the trend, I found it too demeaning to start following the trend followers. I tried to pick the reversal point instead, needless to say, without success. I had some temporary profits in the early part of 1984, but I gave them all back. I was again engaged in a speculation against the dollar at the time I wrote this chapter. Writing it has undoubtedly helped to clarify my thoughts. Admittedly, the theory is far too abstract to be of much use in making concrete predictions. Specifically, the turning point cannot be determined until it has actually occurred. But as we shall see, the theory can be very useful in interpreting events as they unfold. The credit ambulatory cycle. There seems to be a special affinity between reflexivity and credit. That is hardly surprising. Credit depends on expectations. Expectations involve bias. Hence, credit is one of the main avenues that permit bias to play a causal role in the course of events. But there is more to it. Credit seems to be associated with a particular kind of reflexive pattern that is known as boom and bust. The pattern is asymmetrical. The boom is drawn out and accelerates gradually. The bust is sudden and often catastrophic. By contrast, when credit is not an essential ingredient in a reflexive process, the pattern tends to be more symmetrical. For instance, in the currency market, it does not seem to make much difference whether the dollar is rising or falling. The exchange rate seems to follow a wave-like pattern. I believe the asymmetry rises out of a reflexive connection between loan and collateral. In this context, I give collateral a very broad definition. It will denote whatever determines the creditworthiness of a debtor, whether it is actually pledged or not. It may mean a piece of property or an expected future stream of income. In either case, it is something on which the lender is willing to place a value. Valuation is supposed to be a passive relationship in which the value reflects the underlying asset. But in this case, it involves a positive act. A loan is made. The act of lending may affect the collateral value. That is the connection that gives rise to a reflexive process. It will be recalled that we have analyzed reflexivity as two connections working in opposite directions. The normal connection, where a value is placed on future events, as in the stock market or banking. We have called it the cognitive function. and a perverse connection in which expectations affect that which is expected. We have called it the participating function. The participating function is perverse because its effect is not always felt, and when it does operate, its influence is so difficult to disentangle that it tends to go unrecognized. The prevailing view of how financial markets operate tends to leave the participating function out of it. For instance, in the international lending boom, bankers did not recognize that the debt ratios of borrowing countries were favorably influenced by their own lending activity. In the conglomerate boom, investors did not realize that per-share earnings growth can be affected by the valuation they place on it. At present, most people do not realize that the erosion of collateral values can depress the economy. The act of lending usually stimulates economic activity. It enables the borrower to consume more than he would otherwise, or invest in productive assets. There are exceptions, to be sure. If the assets in question are not physical but financial ones, the effect is not necessarily stimulative. By the same token, debt service has a depressing impact. Resources that would otherwise be devoted to consumption or the creation of a future stream of income are withdrawn. As the total amount of debt outstanding accumulates, the portion that has to be utilized for debt service increases. It is only net new lending that stimulates, and total new lending has to keep rising in order to keep net new lending stable. The connection between lending and economic activity is far from straightforward. That is, in fact, the best justification for the monetarists' preoccupation with money supply to the neglect of credit. The major difficulty is that credit need not be involved in the physical production or consumption of goods and services. It may be used for purely financial purposes. In this case, its influence on economic activity becomes problematic. For purposes of this discussion, it may be helpful to distinguish between a real economy and a financial economy. Economic activity takes place in the real economy, while the extension and repayment of credit occur in the financial economy. The reflexive interaction between the act of lending and the value of the collateral may then connect the real and the financial economy, or it may be confined to the financial economy. Here we shall focus on the first case. A strong economy tends to enhance the asset values and income streams that serve to determine creditworthiness. In the early stages of a reflexive process of credit expansion, credit involved is relatively small, so that its impact on collateral values is negligible. That is why the expansionary phase is slow to start with, and credit remains soundly building, increases in importance and begins to have an appreciable effect on collateral values. It continues until a point is reached where total credit cannot increase fast enough to continue stimulating the economy. By that time, collateral values have become greatly dependent on the stimulative effect of new lending, and as new lending fails to accelerate, collateral values begin to decline. The erosion of collateral values has a depressing effect on economic activity, which in turn reinforces the erosion of collateral values. Since the collateral has been pretty fully utilized at that point, a decline may precipitate the liquidation of loans, which in turn makes the decline more precipitous. That is the anatomy of a typical boom and bust. Booms and busts are not symmetrical because at the inception of a boom, both the volume of credit and the value of the collateral are at a minimum. At the time of the bust, both are at a maximum. But there is another factor at play. The liquidation of loans takes time. The faster it has to be accomplished, the greater the effect on the value of the collateral. In a bust, the reflexive interaction between loans and collateral becomes compressed within a very short time frame, and the consequences can be catastrophic. It is the sudden liquidation of accumulated positions that gives a bust such a different shape from the preceding boom. It can be seen that the boom-bust sequence is a particular variant of reflexivity. Booms can arise whenever there is a two-way connection between values and the act of valuation. The act of valuation takes many forms. In the stock market, it is equity that is valued. It is possible, although unlikely, that a boom could be generated without any credit expansion. The two examples we studied in the stock market, the REIT and conglomerate booms, could, in theory, have unfolded without the stocks being used as collateral, although in practice there was a lot of credit involved. In the absence of credit, the reversal would be a more gradual process. The contraction would not be a mirror image of the expansion for the reversal than at the inception of a trend, but the compression that is characteristic of busts would be absent. Both the boom-bust pattern and its explanation are almost too obvious to be interesting. The amazing thing is that the reflexive connection between lending and collateral has not been generally recognized. There is an enormous literature on the trade cycle, but I have not seen much awareness of the reflexive relationship described here. Moreover, the trade cycles that are generally discussed in textbooks differ in duration from the credit cycle I am discussing here. They are short-term fluctuations within a larger pattern. There is an awareness of a larger cycle, usually referred to as the Kondratiev wave, but it has never been scientifically explained. At present, there is much concern that we may be approaching another recession, but the general assumption is that we are dealing with a recession just like any other. The fact that we are in the declining phase of the larger cycle is usually left out of account. I contend that all previous recessions since the end of World War II occurred while credit was expanding, while the one we may or may not be facing now would occur when borrowing capacity in the real economy is contracting. This creates a situation that has no precedent in recent history. Exactly where we are in the larger cycle is difficult to determine. I must confess I have been confused on the issue since 1982. The reason for my confusion is that while the boom has clearly run out of steam, the bust has not taken place. Busts can be very disruptive, especially if the liquidation of collateral causes a sudden compression of credit. The consequences are so unpleasant that strenuous efforts are made to avoid them. The institution of central banking has evolved in a continuing attempt to prevent sudden, catastrophic contractions in credit. Since a panic is hard to arrest once it has started, prevention is best practiced in the expansionary phase. That is why the role of central banks has gradually expanded to include the regulation of the money supply. That is also why organized financial markets regulate the ratio of collateral to credit. Until now, the authorities have been able to prevent a bust. We find ourselves in a twilight zone where the normal process of credit expansion culminated long ago, but the normal process of credit contraction has been prevented by the authorities. We are in uncharted territory because the actions of the authorities have no precedent. The fact that banks and organized financial markets are regulated complicates the course of events tremendously. Financial history is best interpreted as a reflexive process in which there are two sets of participants instead of one: competitors and regulators. Such a system is much more complex than the case we studied in the stock market. There, the regulatory environment was more or less fixed. It was the backdrop against which the drama was acted out. Here, the regulatory environment is an integral part of the process. It is important to realize that the regulators are also participants. There is a natural tendency to regard them as superhuman beings who somehow stand outside and above the economic process and intervene only when the participants have made a mess of it. That is not the case. They also are human, all too human. They operate with imperfect understanding, and their activities have unintended consequences. Indeed, they seem to adjust to changing circumstances less well than those who are motivated by profit and loss, so that regulations are generally designed to prevent the last mishap, not the next one. The deficiencies of regulation tend to be more noticeable when conditions are rapidly changing, and conditions tend to change more rapidly when the economy is less regulated. We begin to discern a reflexive relationship between the regulators and the economy they regulate. It gives rise to a process that takes place concurrently with the process of credit expansion and contraction, and interacts with it. It is no wonder that the result is so complex and perplexing. The regulatory cycle does not have the asymmetric character of the credit cycle. It seems to fit the wave pattern we developed for the currency market better than the boom and bust pattern of the credit cycle. Just as freely floating currencies tend to fluctuate between over and undervaluation, so market economies tend to fluctuate between over and under regulation. The length of the cycle seems to be correlated with the credit cycle, and one can sense intuitively why that should be so. Credit expansion and contraction have much to do with changes in the economy, which in turn have a bearing on the adequacy of regulations. Conversely, the regulatory environment influences not only how fast credit can expand, but also how far. Clearly, there is a two-way connection between credit and regulation, but it is far from clear to me at this stage of the investigation what pattern, if any, the interaction follows. That is the main source of my confusion. We have identified a credit cycle that follows a boom-bust pattern, a regulatory cycle that is more wave-like, and an interplay between the two whose pattern is unclear. There are, of course, many secular developments involved as well, some of which relate to credit, some to regulation, and some to both. We have mentioned that central banks tend to get stronger after each crisis. That is a secular development that renders each cycle unique. In the Great Depression, both the banking system and the international trading system collapsed, making the contraction of credit and economic activity much more severe than it would have been otherwise. We can be certain that every effort will be made to avoid a similar collapse in this cycle. We did not dwell on the information revolution or on the improvements in transportation that have helped the development of an integrated world economy. The outcome of all these influences is a unique course of events that is easier to explain than to predict. Looked at from this perspective, the entire post-war period is part of a large expansionary boom that is now well advanced and ripe for a bust. The bust has been avoided, however, by the intervention of the authorities at crucial moments. The same post-war period has also seen an almost complete swing from government regulation to unrestrained competition. We are now at a curious moment where the bias in favor of deregulation is still on the rise, yet the need for government intervention in specific areas is beginning to reassert itself. The banking industry, for one, is already on the way to becoming more regulated. One could try and write a history of the post-war era in these terms. The present credit cycle started after the end of World War II. The origins of the regulatory cycle go back even farther to the New Deal, although the creation of the Bretton Woods system can be taken as the starting point as far as the world economy is concerned. The expansion that followed was intimately related to the removal of restrictions on international trade and investment. But international capital movements created problems for the Bretton Woods system that were never anticipated and remain unresolved. I shall not attempt to present the complete story here. I shall start at the point where I became actively involved, and I shall follow the path of my own involvement. This will give the investigation a more experimental character. My experience began after the breakdown of the system of fixed exchange rates in 1973. Relationships that had been fixed became subject to reflexive influences, and my interest veered from specific companies and industries to macroeconomic processes. My study of growth banks in 1972 constituted a transition point, although I did not know it at the time. With the passage of time, I found the instability of macroeconomic trends increasingly disturbing in both a subjective and an objective sense, and I decided to distance myself from active investing in 1981. After the crisis of 1982, I made a theoretical study of the international debt problem. I was under the mistaken impression that the crisis of 1982 constituted the climax in the process of credit expansion. I thought that the authorities were not doing enough to prevent a bust. I failed to realize that they were doing too much. They actually kept credit expanding, albeit on a more unsound basis than ever. The United States replaced less developed countries as the borrower of last resort, and commercial banks tried to grow their way out of the loans made to less developed countries by aggressively expanding in other directions. This led to another series of crises in 1984 that constituted the real turning point for the banking and thrift industries. We are now suffering from the after effects of that climax. The United States government continues to borrow on an ever-increasing scale, but here too a turning point is at hand. The dollar has begun to decline, and foreigners are going to be repaid in a depreciating currency. Perhaps the last great engine of credit creation that is still going full blast is in the stock market, where merger mania is at its peak. but it does not have a stimulating effect on the real economy. The theoretical framework of an interrelated credit and regulatory cycle became somewhat clearer to me in the course of writing this book, although I cannot claim that the process of clarification is complete. Alchemy, an evaluation of the experiment. In evaluating my approach, we must distinguish between its ability to produce profits in financial markets and its ability to predict the future course of events. The fact that the distinction is necessary has far-reaching implications. My financial success stands in stark contrast with my ability to forecast events. In this context, we must distinguish between events in financial markets and events in the real world. Events in financial markets determine financial success. Events in the real world are relevant only in evaluating the scientific merit of my approach. Even in predicting financial markets, my record is less than impressive. The best that can be said for it is that my theoretical framework enables me to understand the significance of events as they unfold, although the record is less than spotless. One would expect a successful method to yield firm predictions, but all my forecasts are extremely tentative and subject to constant revision in the light of market developments. Occasionally, I develop some conviction, and when I do, the payoff can be substantial. But even then, there is an ever-present danger that the course of events fails to correspond to my expectations. My approach works not by making valid predictions, but by allowing me to correct false ones. With regard to events in the real world, my record is downright dismal. The outstanding feature of my predictions is that I keep on expecting developments that do not materialize. How can financial success and predictive failure be reconciled? That is the question I shall address in this chapter. But before I do so, I must remind the reader why it arises in the first place. My decision-making process was greatly influenced by personal factors, such as my presence or absence from the office. The fact that the monetary results served as a possible criterion of the validity of my ideas made me try harder than I would have otherwise. This is borne out by the fact that my understanding was much hazier and my moves in the market more tentative during the control period than they were at the height of the experiment. Such haziness is quite common. It is the sharp focus that I managed to attain in the course of the experiment that is rather exceptional. I was greatly helped by the discipline of having to write down my thoughts. My arguments may not strike the reader as particularly well organized, but they are certainly more consistent than they would have been if I had not taken the trouble to formulate them in writing. I was also inspired by the fact that I was able to combine the two great abiding interests in my life: philosophical speculation and speculation in financial markets. Both seemed to benefit from the combination. Together, they engaged me more than either one on its own. The other consideration has to do with external events. For instance, I recall the time, in 1981 to 82, when the Federal Reserve sought to control the quantity of money and allowed market forces to set interest rates. The market for government bonds, and to a lesser extent for stocks and currencies, became like a casino. And my approach of formulating hypotheses and testing them against the market became worse than useless. By the time I recognized a market trend and formulated a hypothesis to explain it, the trend had already changed, and I had to find a new hypothesis. The result was that I was always lagging behind the market and kept on getting whipsawed until I abandoned the hopeless struggle and delegated the task of gambling in government bond futures to someone more qualified. I found a computer-based speculator, Victor Niederhofer, who had developed a system using the assumption that the market is a casino. He operated successfully until...
Thank you, George. George Soros, everybody. Okay, now it's time to close this seance / summoning ritual and banish George's spirit back to where it belongs, wherever you're at right now, George. So spirit be gone till I call you forth again. The next episode. That's right. I know it says this is the conclusion of public relations and an economic perspective. yeah, I'm wrapping up the public relations part of it today, but we're going to be inviting George back via a seance and summoning ritual in the next show, and so you guys will definitely want to tune in for that. Spirit be gone, get the hell out of here. Till I call ye forth again. And once if you're gonna die or whatever, sometime in the near future, just hey, I'm just trying, just come on to my apartment, and I'm a great spiritual medium, so you can work through me if you want. If you have things that are left undone on the planet, what have you, I'd be more than happy to be that guy for you, George. You're a human conduit in the world of form when you finally pass. But okay, public relations and the internet in the 21st century. Oh, by the way, caller lines are wide open as well. If you want to call in, be a part of the big show, please feel free. That number is 657 383 1825. Once again, that's 657 383 1825. Caller lines are wide open. There's still about an hour left in the big show. So, audience participation is always encouraged and welcome. Welcome and encouraged, whatever. Public relations and the internet. In the 21st century, the world is wired. From Berlin to Brooklyn, Baghdad to Boise, the internet has become the world's dominant mode of communication. Developing a winning website. In many ways, the organization's website is the most important interface with the public. Today, journalists and others turn to the website first for an introduction to the organization. The aim of any website is to provide information that visitors are looking for. The more you achieve that objective, the more sticky your site becomes. Stickiness is often measured by the amount of time visitors spend at a site and how many pages they view. For example, if visitors spend 10 minutes at the website and view 5 or more pages, you've achieved stickiness. How would you create a winning website? By first asking and answering several strategic questions. 1, what is our goal? To extend the business, sell more products, make more money, win support for our position, turn around public opinion, introduce our company. Without the answers to these fundamental questions, the what and how of a website are inconsequential. Just as any other pursuit in public relations, the overriding goal must be established first. 2, what content will we include? The reason some websites are tedious and boring is because little forethought has gone into determining the content of a site. Simply cramming chronological news releases onto a website will not advance an organization's standing with its publics. Rather, content must be carefully considered in substance and organization before proceeding with a site. 3, how often will we edit? Often the answer to this question is not enough. Stale news and the lack of updating are common website problems. Sites must regularly be updated. Another problem is overwriting. People seem to feel that because the web is free, they can write endlessly. Of course, they can, but no one will read it. So an editorial process to cull information down to its most essential parts is a necessity for a good website. 4, how will we enhance design? Like it or not, The style of the site is most important. If an organization's homepage isn't attractive, it will not get any hits. Good design makes complicated things understandable, and this is essential in a website. The web is a largely visual medium, so great care should be taken to professionally design a site. 5, how interactive will it be? Traditional communication is unidirectional, one way. You read it or view it, and that's where the process stops. The great attraction of the web, on the other hand, is that it can be bidirectional. Communication can be translated into an interactive vehicle, a game, an application, or an email chat vehicle. This is what distinguishes the good sites from mediocre ones. 6, how will we track use? As in any other communications project, the use of a website must be measured. The most basic form of cyberspace measurement is the rough yardstick of hits to the site. But like measuring press clippings, this does not tell you whether your information is being appreciated, acted on, or even read. Measuring site performance, therefore, should be a multifaceted exercise that includes such analysis as volume during specific times of day, kind of access, specific locations on the site to which visitors are clicking first, and the sequencing through the site that visitors are following. 7, who will be responsible? Managing a website, if it is done correctly, must be someone's full-time job. The website must be treated as a first line of communication to the public, which requires full-time attention. Blogs, the latest phenomenon. Blogs are everywhere. To date, there are over 1.6 billion websites in the world, and more than 500 million are recognized as blogs. Their authors account for over 2 million blog posts daily. As a consequence, blogs are starting to feel their oats in terms of communications power. There are 2 categories of blogs. One is the traditional weblog, in which a web surfer shares his online discoveries. The second is the web diary, in which a person shares his or her thoughts of the day. Often blogs of one style have elements of the other. A diarist might discuss a link, while traditional web bloggers commonly ramble on about something that happened to them that day. In terms of public relations, use of blogs, organizations can use them to deliver information, product uses, sales data, consumer tips, and so on in a more personal way. Organization blogs, like direct mail, might also serve to interest potential customers in a firm's expertise. Readership can be expanded through registering on the growing number of blog search engines. Public relations people should also monitor any blogs in a company or industry that are deemed influential. Often these are negative blogs. In the case of Walmart, for example, public relations professionals need to regularly monitor anti-company blogs, such as alwayslowprices.net and Labor Blog, to find out the latest hot issues among the company's critics. Blogs also can be useful as an internal communications vehicle. Among possibilities for internal blogs are the following. Projects. Project leaders can maintain blogs to announce project status or development. Departments. Departments can maintain blogs to inform the rest of the organization about offerings and achievements. Brainstorming. Employees in a department or on a team can brainstorm about strategy, process, and ideas on their blog. Customers. Employees can share with others internally the substance of customer visits or phone calls. Predictably, another outgrowth of the spread of blogs is the existence of spam blogs, or just plain splogs, or phony blogs, designed to promote everything from gambling websites to pornography. A typical splog contains gibberish and is full of links to other websites it is trying to promote. Because search engines like Google and Yahoo base their rankings on how many other websites linked to a particular site. The splogs can help artificially inflate a site popularity. Although only in their infancy, there is no question that blogs are being woven into the culture and fabric of public relations as a method of building consumer loyalty, as a target of pitches, and even as a sardonic watchdog for the public relations industry. With companies from Microsoft to General Electric to Singular Wireless adopting blogs to promote products and services, the use of blogs as a communication vehicle will only increase. Dealing with the media online. In the 21st century, the internet has become the favorite tool of reporters for discovering organizational information. Research indicates that journalists now overwhelmingly rank corporate websites as their most important source of financial information. So reaching reporters online has become a frontline responsibility for public relations professionals. The basics of online media relations include the following: website newsroom, the best organizations create extranets developed exclusively to serving the media as derivatives of their websites. These corporate newsrooms include all the traditional press materials that the media require. News releases. Every website begins with news releases, most often organized chronologically. However, journalists complain that they don't know precisely when an organization raised its prices or announced its earnings or promoted its president. Therefore, the best web newsrooms organize releases both chronologically and by subject, with a search engine capable of pointing readers toward specific subjects. Executive speeches. All major speeches delivered by management should be included at the corporate newsroom site. The best sites offer an interactive speech feature through which speeches are automatically emailed to journalists or others who request it. Annual quarterly reports. Every public company is obliged to report earnings to shareholders 4 times a year and typically issue 3 quarterly reports and 1 annual report. Quarterlies and annuals should appear on the corporate newsroom site. Meetings. Companies in remote locations, in particular, have begun to webcast their annual gathering of shareholders so that those unable to attend in person may do so electronically. FAQs. The most frequently asked questions posed by reporters ought to be part of the newsroom site. Also, FAQs ought to maintain the most basic corporate information, from number of offices and employees to headquarters location and stock symbol. Interviews. Online press conferences and webcasts have also become standard fare, with the company notifying journalists of the time and password necessary to access a particular executive presiding as an online interviewee. Digital press kits. All the material included in a corporate press kit, releases, photos, backgrounders, are duplicated on the internet for downloading purposes to journalists. Photographs, profiles, ad copy, and so on. Online executive photographs and other relevant photographs are standard at corporate newsroom sites. So too are executive biographical files. Corporate newsrooms might even offer video versions of corporate advertising. Finally, reporters appreciate ease of access to locate the press room and its elements. After hours contact numbers clearly listed and downloadable logos for ready use. News release via news wires. It has become essential for public relations companies to issue news releases over news wires. Why? Newswire copy gets picked up by online databases such as AOL and Yahoo. If a company wants its shareholders and potential investors to know of its activities in order to notify them online, its releases must be included on news wires. News wires are of three types. 1. General wires. The Associated Press, AP, is the granddaddy of all general wire services, reporting on general news of interest to the broad society. United Press International, UPI, that used to compete directly with AP, fell into financial ill health starting with cutbacks in 1982, and there was the 1999 sale of its broadcast client list to AP. It's diminished as a news factory, but still survives by concentrating on smaller niche markets. 2. Financial wires. Dow Jones, the wire service of the Wall Street Journal, is perhaps the most well-known financial wire. Reuters is known as the International Financial Wire. Bloomberg, the creation of a former Wall Street broker turned New York City mayor, you may have heard of him, has emerged as another powerful financial wire service force in both print and broadcast. 3. Fixed wires. As opposed to general and financial wires, other wire services, the most prominent being PR News Wire, Business Wire, and Market Wire, are paid services that reproduce organizational news announcements verbatim for a fee. All of these wire services report online, which means that releases are automatically filed online on online stock databases. This allows online users to track a specific company's announcements, and is one reason why most public held companies today release via wire. Online publicity. Online publications, e-zines, such as Salon and Slate, and online special interest sites such as Oxygen.com and iVillage.com, designed for women, and SeniorNet.org for senior citizens, and so on, offer opportunities for publicity. Financial news services such as Fool.com, TheStreet.com, and CBSMarketWatch.com are also ready outlets for publicity. Okay, moving on, ladies and gentlemen. That will wrap up my analysis of the practice of public relations, 10th edition, 2007, written by Fraser P. Seidel. Borrowed heavily from him in this little presentation. All right, so let's see what's going on in the wonderful world of finance. These are more timely top stories. Let's see here. Bitcoin and cryptocurrencies are having a very bad day. Bitcoin and cryptocurrencies having a very bad day. Let's see. Just going to have a... Oh. Okay. Okay, so this comes to us from Jonathan Schreiber at TechCrunch.com. The price of Bitcoin and other currencies tanked today, continuing a months-long slide that has seen the value of the digital currency slide by more than $2,000 from highs of above $10,000 earlier in the year. Investors are still speculating about the cause of the crash, but hopeful cryptocurrency bulls before today had hoped that $8,000 would be the new floor for Bitcoin. No longer. Today, the price of Bitcoin dropped to $7,448.75, down from around $8,000 earlier in the day. Investors aren't sure what's behind the crash, but Bitcoin's commentariat pointed to two likely culprits. One was the underwhelming performance of Facebook's chief executive, Mark Zuckerberg, in testimony before Congress on the Libra cryptocurrency that his company is leading the charge to create. Low lights. Oh, okay, well, let's just keep moving on here. Yeah, well, shoot. I guess that's a whole different story in and of itself. However, an underwhelming performance from Zuckerberg and the potential fate of Libra, which cryptocurrency purists have scoffed at anyway, may be less concerning for the Bitcoin crowd than developments happening in Google's quantum computing research labs around the world. Earlier today, Google declared quantum dominance, indicating that it had solved a problem using quantum computing that a supercomputer would have taken years to solve. That's great news for theoretical physicists and quantum computing aficionados, but less good for investors who put their faith and billions of dollars into a system of record whose value depends on its inability to be cracked by computing power. When news of Google's achievement first began trickling out in late September, thanks to reporting by the Financial Times, Bitcoin experts dismissed the notion that it would cause problems for the cryptocurrency. We still don't even know if it's possible to scale quantum computers. Quite possible that adding qubits will have an exponential cost, wrote early Bitcoin developer Peter Todd on Twitter. Okay, so the comments flagged by Cointelegraph seem to indicate that the economic cost of cracking Bitcoin's cryptography is far beyond the means of even Alphabet's multi-billion-dollar budgets. Still, it has been a dark few months for cryptocurrencies after steadily surging throughout the year. The real test, of course, of the viability of Bitcoin and the other cryptographically secure transaction mechanisms floating around the tech world these days is whether anyone will build viable products on their open architectures. Aside from a few flash-in-the-pan fads, the jury is very much still out on what the verdict will be. That uncertainty affects more than just Bitcoin, and indeed, the rest of the market also tumbled. As CoinDesk, all right, so. All right, moving on. From town to town. Here. A little bit more about Mark Zuckerberg, maybe? Lowlights from Zuckerberg's Libra testimony in Congress. I don't control Libra was the central theme of Facebook CEO Mark Zuckerberg's testimony today in Congress. The House of Representatives unleashed critiques of his approach to cryptocurrency, privacy, encryption, and running a giant corporation during 6 hours of hearings. Zuckerberg tried to assuage their fears while stoking concerns that if Facebook doesn't build Libra, continue reading. Well, dang, little Marky Zuckerberg. Okay, let's see. So, okay. I don't control Libra was the central theme of Facebook CEO Mark Zuckerberg's testimony today in Congress. The House of Representatives unleashed critiques on his approach to cryptocurrency, privacy, encryption, and running a giant corporation during 6 hours of hearings. Zuckerberg tried to assuage their fears while stoking concerns that if Facebook doesn't build Libra, the world will end up using China's version. Yet Facebook won't stop shaking up society, with Zuckerberg saying its News tab feature will be announced this week. During the hearing before the House Financial Services Committee, you can watch here. Okay, maybe we'll check that out. Zuckerberg recommitted to only releasing Libra with the so all right, let's take that from the top. During the hearing before the House Financial Services Committee that you can watch here, that's going to be on the YouTube channel, but we'll have audio as well. I think it'll speak for itself to all the Blog Talk Radio people. But anyway, Services Committee that you can watch here. Zuckerberg recommitted to not only releasing Libra with full U.S. regulatory approval, but given the tone of the questioning and Zuckerberg's lack of fresh answers since Facebook's David Marcus testified about Libra in July, Libra now looks even less likely to launch in 2020. All right, that being said, well, I don't know how long it's going to be, but let's check it out. Okay, Marky Mark. Little Marky Zuckerberg. No, 6 hours, 14 minutes long. It's pretty goddamn long. Okay, don't have time for that. The hearing started tensely with Representative Maxine Waters, Democrat, California, declaring that perhaps you believe that you're above the law, and it appears that you are aggressively increasing the size of your company and are willing to step over anyone, including your competitors, women, people of color, your own users, and even our democracy to get what you want. In fact, you have opened up a serious discussion about whether Facebook should be broken up. However, some members of Congress used their time to advocate for American dominance instead of heavy regulation. Representative Patrick McHenry, Republican, North Carolina, said the question is, are we going to spend our time to devise ways for government planners to centralize and control as to who, when, and how innovators can innovate? Many Republicans complimented Zuckerberg on his business acumen, though none showed outright support for Libra. So, with few highlights or positive moments coming from the hearing, here are the major takeaways, followed by a chronicle of the top exchanges between Zuckerberg and Congress. Zuckerberg claims China will soon have its own version, so regulators shouldn't block Libra. He's open to regulators requiring Libra to be majority backed by the US dollar. Zuckerberg would leave inheritance to his children in Libra since it's backed 1-to-1 with real currency. He wouldn't commit to blocking anonymous wallets, but he's open to baking more anti-money laundering into Libra's network. Zuckerberg plans to expand verifying users via government ID to battle abuse of Facebook. He said Libra's partners left because it's a risky project and there's been a lot of scrutiny. Zuckerberg confirmed the Libra Association has abandoned or modified its plan to deal themselves dividends on interest from Libra Reserve. Facebook will pull out of Libra if it does something Facebook can't allow or that it's prohibited from by regulators. Zuckerberg didn't discuss Facebook's policy allowing misinformation and political ads with President Trump during their meeting. He says Facebook is developing anti-deepfakes technology and a policy about takedowns. Deepfakes technology. Okay, anyway. He repeated his call for more government regulation instead of Facebook making its own rules. Facebook will comply with subpoenas for info on discrimination and housing ads. Zuckerberg wouldn't commit to trying out the role of Facebook content moderator. Facebook plans to announce its upcoming news tab this week. Congress's questions were smarter than a year ago, but still pried little new information on Libra out of Zuckerberg. Zuckerberg repeatedly relied on the Libra Association's independence from Facebook to avoid substantial answers. On Libra versus China, Zuckerberg tried to leverage nationalist sentiment to deflect scrutiny. As soon as we put forward the white paper around the Libra project, China immediately announced a public-private partnership working with companies to extend the work that they've already done with Alipay into a digital renminbi as part of the Belt and Road initiative that they have. And they're planning on launching that in the next few months. He later said that for Libra, Chinese companies would be the primary competitors. What if the Libra Association chooses to add the Chinese currency to the basket used to back Libra and reduces the US dollar's fraction of the basket? I think it would be completely reasonable for our regulators to try to implement a restriction that says that it has to be primarily US dollars, Zuckerberg responded in one of his most substantial answers of the day. Zuckerberg was receptive to feedback that the Libra Association should keep its white paper updated. As for why Libra isn't just backed 100% with the US dollar, Zuckerberg explained that I think from a US regulatory perspective, it would probably be significantly simpler. But because we're trying to build something that can also be a global payment system that works in other places, it may be less welcome in other places if it's only 100% based on the dollar. Still, Zuckerberg said he would leave his children their inheritance in Libra because it's backed 1-to-1 by the Libra Reserve. On Libra and regulation, Zuckerberg wouldn't commit to blocking anonymous Libra wallets that could facilitate money laundering. only saying Facebook's own Calibra wallet would have strong identity checks. He did say Libra was exploring whether it could encode know your customer protections at the network level instead of relying on developers to build this into their wallets. On whether Facebook will increasingly seek to verify users' identities through government ID, Zuckerberg was enthusiastic. This is an area where I think we are going to do a lot more in the years to come. We started with political ads. Over the coming years, for anything that people are doing that is sensitive, we're likely going to increasingly require verification either by government ID or other things, so we can have a clear sense of people's authentic identity, said Zuckerberg. Representative Dean Phillips, Democrat from Minnesota, mentioned this could be a competitive advantage, implying Facebook's size and resources might allow it to embark on a verification initiative other companies couldn't. Facebook has assured regulators that Calibra's data would be kept separate from the social network. But Facebook said the same when it acquired WhatsApp, then reneged and integrated its data. This time around, Congresswoman Nydia Velasquez declared that we're going to need to make sure that you learned that you should not lie. When pushed on why Libra Association members like Visa, Stripe, and eBay left the organization, Zuckerberg admitted, I think because it's a risky project and there's been a lot of scrutiny. Zuckerberg struck back at finance incumbents saying, I think that the U.S. financial industry is just frankly behind where it needs to be to innovate and continue American financial leadership going forward. In an awkward moment, Zuckerberg could not answer which Libra members were run by women, minorities, or LGBTQ people. Is it true that the overwhelming majority of persons associated with this endeavor are white men? Representative Al Green, Democrat, Texas, asked. Congressman, I don't know off the top of my head, Zuckerberg responded. Zuckerberg was criticized for trying to profit and potentially helping money laundering while claiming Libra is designed to help the unbanked. Zuckerberg said the Libra Association hadn't nailed down policies about whether anonymous payments are allowed. Representative Brad Sherman, Democrat, California, said for the richest man in the world to come here and hide behind the poorest people in the world and say that's who you're really trying to help. You're trying to help those for whom the dollar is not a good currency, drug dealers, terrorists. Some people of Congress, like Sherman, chose to use their entire time monologuing instead of actually asking questions. Zuckerberg got a chance to clear up a major snafu from Marcus's testimony, where he said the Libra Association was in contact with the Swiss data regulator, which CNBC reported hadn't heard from Libra. Zuckerberg explained today that the Libra Association had been in contact with the primary Swiss financial market supervisory authority instead. He says Facebook plans to earn money from Libra on ads from small businesses if cheap transactions lead to more e-commerce. In one revealing exchange, Representative Lance Gooden, a Republican from Texas, asked if the Libra Association still planned to offer profit incentives by offering dividends based on interest earned on currency in the Libra reserve after expenses are paid. Zuckerberg said the idea had either been modified or abandoned. How will the reserve be invested? Users of Libra do not receive a return from the reserve. The reserve will be invested in low-risk assets that will yield interest over time. The revenue from this interest will first go to support the operating expenses of the association, to fund investments in the growth and development of the ecosystem, grants to nonprofit and multilateral organizations, engineering research, etc. Once that is covered, part of the remaining returns will go to pay dividends to early investors in the Libra investment token for their initial contributions. Because the assets in the reserve are low risk and low yield, returns for early investors will only materialize if the network is successful and the reserve grows substantially in size. Claiming Facebook isn't Libra. Throughout the testimony, Zuckerberg tried to distance himself and Facebook from the Libra Association's decision-making process. We might be required to pull out if the association independently decides to move forward on something that we're not comfortable with, Zuckerberg said. That means if Facebook can't launch Libra, it could still theoretically launch without the social network, though it does most of the engineering heavy lifting. The strategy was crystallized by Zuckerberg's response to whether he would commit to moving Libra's headquarters from Switzerland to the US. At this point, we do not control the independent Libra Association, so I don't think we can make that decision, said Zuckerberg. Representative Ayanna Pressley, Democrat from Massachusetts, refuted this position, stating, Mr. Zuckerberg, Libra is Facebook, and Facebook is you. Control Libra. Facebook is you. Control Libra. Okay. Argument. Control Libra argument provides Facebook and Libra an escape hatch from criticism, because any member and even the newly appointed chairperson and board can't unilaterally control or make promises about its actions on misinformation and encryption. Many Congress members remain fixated on Facebook's recently solidified policy of refusing to submit political ads for fact-checking. Representative Sean Casten, Democrat, Illinois, asked if in Zuckerberg's recent meeting with President Trump, did anyone discuss the policy change along the exemption of political figures and parties from misinformation prohibition on Facebook. Zuckerberg responded, Congressman, that did not come up. Quieting theories that Trump pushed for the policy that would exempt false claims in his ads. Zuckerberg defended the policy to Representative Alexandria Ocasio-Cortez, Democrat, New York, saying, I think lying is bad. And I think if you were to run an ad that had a lie, that would be bad. But that outside of calls for violence or voter suppression, Facebook thinks it's best to leave lies in ads and politicians so they can be scrutinized by the press and public. Yet that too heavily leans on the media to scrutinize thousands of ad variants being run as part of multi-hundred million dollar political ad campaigns. Representative Ann Wagner, representative from the great state of Missouri, chided Zuckerberg, saying, you're not working hard enough to stop the spread of child exploitation imagery online, despite Facebook submitting millions of reports. She brought up worries that Facebook moving entirely to encrypted messaging could hide child abusers. And Zuckerberg merely said, I think we work harder than any other company. He failed to explain how Facebook could continue improving detection through encryption. Oddly, Zuckerberg was directly confronted about his views on vaccines, since Facebook works to hide vaccine hoaxes and avoid recommending groups spreading unverified information about them. I don't think it would be possible for anyone to be 100% confident, but my understanding of the scientific consensus is that it is important that people get their vaccines. Zuckerberg said, defending Facebook's decision to hide some of this content. In another strange moment, Representative Madeline Dean, Democrat from Pennsylvania, demanded if Facebook had bought blocks of hotel rooms at Trump properties but never used them just to curry favor with the president. Zuckerberg said he'd never heard of that and would be surprised if it was true. On deep fakes, Zuckerberg confirmed that I think deep fakes are clearly one of the emerging threats that we need to get in front of and develop policy around to address. We're currently working on what the policy should be to differentiate between media that has manipulated and been manipulated by AI tools like deepfakes, with the intent to mislead people. Zuckerberg later said the doctored Nancy Pelosi video should have been flagged sooner and highlighted Facebook needs a separate deepfakes policy. Yet, Facebook's policy allows politicians' ads to mislead people, weakening faith that it will properly address this new problem. Questions about Facebook's fair practices led Zuckerberg to reiterate his call for regulation, saying, I think we need federal privacy legislation. I think we need data portability legislation. I think clear rules on elections-related content would be helpful too, because it's not clear to me that we want private companies making so many decisions on these important areas by themselves. On diversity, discrimination, and moderation. Regarding housing discrimination via Facebook ads, Zuckerberg committed to working with regulators to provide information under subpoena. Noted Facebook has banned discriminatory housing ads and said nobody wants to redline, and I'm sure that was accidental. Zuckerberg received his heaviest criticism of the day from Representative Joyce Beatty, Democrat from Ohio, who grilled him about not knowing if diverse bankers manage Facebook's cash or if diverse law firms handle its court cases. She chastised Facebook for a lack of diverse leadership, saying, this is appalling and disgusting to me. Of COO Sheryl Sandberg, who leads Facebook's Civil Rights Task Force, Beatty said, we know she's not really civil rights. Come on, she's a Jewish woman. That's pretty diverse, right? Not a white man. Tell you what, can't do anything right. Questioning came from Congresswoman Catherine Porter, Democrat, California. She hammered Zuckerberg about Facebook lawyers fighting to avoid liability over data breaches. Then she trapped Zuckerberg on the issue of the mental health harms of being a Facebook content moderator that reviews horrific and graphic violence. Would you be willing to commit to spending 1 hour, and I quote, would you be willing to commit to spending 1 hour a day for the next year watching these videos and acting as a content monitor and only accessing the same benefits available to your workers? She asked. I'm not sure that would serve our community for me to spend my time. Zuckerberg said, what you're saying is you're not willing to do it, she replied. Facebook will announce new services. There'll be more major launches from Facebook that could raise questions about its impact on society. Zuckerberg revealed later this week we will actually have a big announcement coming up on launching a big initiative around news and journalism. where we're partnering with a lot of folks to build a new product that's supporting high quality journalism. Facebook plans to launch a news section featuring headlines from top outlets, though only some will be paid. I think there's an opportunity within Facebook and our services to build a dedicated service, a tab within the apps, for example, where people who really want to see high quality curated news, not just social content. I'm looking forward to discussing that in more length in the coming days. That service is sure to trigger debates about whether Facebook is trustworthy enough to be a formal conduit for news. Overall, the questioning today was much more intelligent than the vague and easily Googleable queries launched at Zuckerberg by Congress in April 2018. We had no Senator we run ads moments. Instead, it was Zuckerberg who repeatedly used the separation between Facebook and the Libra Association, plus the fact that Libra's policies are still being defined, to avoid giving many substantial answers. Combined with the short 5-minute Q&A period per member of Congress, Zuckerberg was often able to just repeat existing talking points. Lighthearted moments of the day. Representative Juan Vargas recognized the tough position Zuckerberg has gotten himself into. It's good to have someone that's sturdy and resilient. You're probably the right person at the right time to take this beating. Yet, Representative McHenry depressingly concluded that after 6 hours, I'm not sure we've learned anything new here. The question is, what array of Libra and Facebook executives would Congress need to have testify together to get real answers to critical questions about how to keep the two from harming the global economy? The hearing is ongoing, and I will continue to update what the hell's going on there. Okay, moving on. Okay, so let's talk a little bit about Facebook's regulation dodge. Facebook is leaning on fears of China exporting its authoritarian social values to counter arguments that it should be broken up or slowed down. Its top executives have each claimed that if the U.S. limits its size, blocks its acquisitions, or bans its cryptocurrency, Chinese companies, absent these restrictions, will win abroad, bringing more power and data to their government. CEO Mark Zuckerberg, COO Sheryl Sandberg, and Vice President of Communications Nick Clegg have all expressed this position. The latest incarnation of this talking point came in today's and yesterday's congressional hearings over Libra, the Facebook spearheaded digital currency it hopes to launch in the first half of 2020. Facebook's head of its blockchain subsidiary, Calibra, David Marcus, wrote in his prepared remarks to the House Financial Services Committee today that I believe that if America does not lead innovation in the digital currency and payments area, others will. If we fail to act, we could soon see a digital currency controlled by others whose values are dramatically different. Marcus also told the Senate Banking Subcommittee yesterday that I believe if we stay put, we're going to be in a situation in 10 to 15 years where half the world is on a blockchain technology that is out of reach of our national security apparatus. This argument is designed to counter House drafted Keep Big Tech Out of Finance legislation that Reuters reports would declare that companies like Facebook that earn over $25 billion in annual revenue may not establish, maintain, or operate a digital asset that is intended to be widely used as a medium of exchange, unit of account, store of value, or any other similar function. The message Facebook is trying to deliver is that cryptocurrencies are inevitable. Blocking Libra would just open the door to even less scrupulous actors controlling the technology. Facebook's position here isn't limited to cryptocurrencies, though. The concept crystallized exactly a year ago when Zuckerberg said in an interview with Recode's Kara Swisher, I think you have this question from a policy perspective, which is, do we want American companies to be exporting across the world? We grew up here. I think we share a lot of values that I think people hold very dear here. And, okay, this is a quote from Zuckerberg, by the way. We grew up here. I think we share a lot of values that I think people hold very dear here. And I think it's generally very good that we're doing this, both for security reasons and from a values perspective. Because I think that the alternative, frankly, is going to be the Chinese companies. If we adopt a stance, which is that, okay, we're going to, as a country, decide that we want to clip the wings of these companies and make it so that it's harder for them to operate in different places where they have to be smaller, then there are plenty of other companies out that are willing and able to take the place of the work that we're doing. When asked if he specifically meant Chinese companies, Zuckerberg doubled down saying, yeah, and they do not share the values that we have. I think you can bet that if the government hears word that it's election interference or terrorism, it's election interference or terrorism, I don't think Chinese companies are going to want to cooperate as much and try to aid the national interest there. Okay, well, ladies and gentlemen, that's a good place to end the big show. I want to thank you all for tuning in. The next show, we're going to be channeling the spirit, maybe a little bit prematurely, of George Soros again. So you won't want to miss a single second of that. Have a great night, everybody.